I can't wait about today because we're going to be talking about the history of dividends in the S&P.
Okay.
So often I get into conversation with other financial advisors where, they'll talk to me about dividends and they're like, oh, that's so old school. Like, how can you still talk about dividends? That built America, but that is not what runs America today.
Right.
And I'm like, do you know anything about the stock market? Like, are you paying attention? Like, did you look at what Meta did last year? Like, that's a sign of what's to come, not what was.
That's right.
When you have a company like Meta, which is Facebook, when you look at their stock, I mean, they've always been known as a growth company. Like, they're social. Like, everybody, a lot of people watch the movie. Like, they're your typical IPO growth. That's all we're ever going to do.
Yep.
And they declared a dividend.
That's right.
Like, what?
Yeah.
What do you mean? Like, is this a trend that's going to happen?
Yeah.
Yes, it is. Like when you have the largest companies in the NASDAQ start offering dividends, things are changing. Have you heard history repeats itself?
No,
I've heard that.
I've heard it a few times.
I think that's what we're about to see. We're going to start seeing a trend in a sector or an industry like the NASDAQ or this tech companies where you're going to start to see more and more companies offer dividend. Microsoft been paying a dividend forever.
Yeah, I think in the early 90s.
Yeah, mid-90s, I think.
Yeah.
And let's back up just a little bit.
Yeah.
So S&P is what? The 500
largest companies that are traded in the U.S. And that can be on the NASDAQ or the New York Stock Exchange.
They just have to be big.
Yep. It's just
and
a
it
benchmark.
resets every year.
Yep.
So
it's all based on market cap.
Yep.
So it's weighted also, which is also important to know. So the bigger you are based on market cap, the more your value kind of, I guess, lifts that benchmark.
So I wasn't planning on talking about that, but since you brought it up, one of my
I think it's important to know because
one of my pet peeves about the S&P and the NASDAQ is they're market cap weighted. That means the larger you are, the more you count towards the index's return. So if you look at the S&P 500, the majority of the index, so 475 of the 500 are actually smaller cap weighted than the top 25 companies in the United States. So you look at 25 of 500 and they're larger than the other 475 combined.
Yeah, we actually did a whole podcast just based on that. It was really, I think, eye-opening, educational about how it can get a little bit skewed there. So we can jump. Yeah,
there's a lot of problems I have as a financial advisor when you look at the actual return of the market. When you look at, if you want to do some research on your own, there's an index which is the equally weighted S&P, and then the S&P that you see on the tickers everywhere. If you look at those two numbers, they're always widely off.
Yeah,
because the top 25, I love equally weighted.
That one makes sense.
Just gives you a much broader understanding of the actual market movement.
Yep.
So when you see the S&P up, whatever it is, you have to understand why is it up. And most of the time it's that top 25 or the NASDAQ. And the NASDAQ is like the top 11. I mean, there's like over 3,000 companies in the NASDAQ.
You have a lot of like really exciting startups in there.
Yep.
But then you've got these behemoths,
huge companies, which are already
trillion,
and they're in the S&P as well.
That's right.
So the same companies.
Yep.
All right. So they're the largest 500 dividends. Just as a recap, let's talk about really the makeup of dividends and the S&P. So if you go like way far back and you look at the S&P like pre-1980, dividends, really made up the S&P. It was a huge part of its return. I didn't look up the actual return, but it was probably north of 60% of the total return of the S&P was made up from dividend income plus growth. And I think that's why a lot of investors, advisors would be like, oh, that's so old school. So, you look at it was 60% back then. You fast forward to today and it's still 40%.
Right.
So the overall return of over 100 years in the S&P, it's still north of 50%. It's 51%. So it's not like, oh, it's 4% or 10% or even 25. It's still over 50%. So you can't be like, oh, dividends don't matter in the market anymore. Yes, they do.
Yeah, especially you take those out of the S&P's
you lose 51%.
Yeah.
from the 80s till now, actually even going back into it, it's still 40% of the return. So it is less, but that's actually going to be changing as more and more of these companies, these large companies that push the market up. That's why it's gone down. Because then after the 80s, you start to see the rise of the IPO, these companies, these true growth companies that weren't paying a dividend.
That's right.
And that's changed the market a bit, where modern investors are like, oh, you don't need a dividend, because I got Amazon, I got Tesla.
I can get the growth and it doesn't matter.
Sure.
Until it does.
Until it does. Because you're like, oh, I made all this wealth, and now you're in retirement, and you're like, I'll just spend my growth. Well, what happens when that growth's not there?
Right.
So we have a podcast coming out real soon that we're going to be talking exactly about that. All right. And so you had this shift in the 80s and really modern times. I think modern, we talk about current, like right now, and I've already alluded to this. There was a big push where most, if not all, of the stocks in the S&P prior to the 80s paid a dividend. That's why it was so big. Now you look at the S&P, actually prior to a couple years ago, and you'd say probably only 60 to 70%, somewhere in that range, paid dividends. Now it's climbing again because you're having a lot more of the larger companies that were not paying dividends start to declare a dividend.
Well, it gets really hard to produce a 20, 30% growth each year when your profits were in the billions. You have these mature companies like an Apple and Nvidia, Amazon. They do great, but how long can they continue to put out a 20%, 30%, 70% year over year return? It just gets to a point where it's just not there to keep doing that.
And the psychology behind that is why, as an investor, if I'm in a growth company and they're only averaging 5% return, that's not attractive when you can go find another company, because there's always going to be those Nvidias, Teslas of the world where they're crushing it every year, and you look at that and you're like, well, this behemoth of a company is still only making me 10%. And they're not paying a dividend. That's why there has to be a transition when they start to slow.
That's right.
Where there has to be an attraction for the investor, because if they're not paying a dividend, you're like, yeah, well, you're not making what you used to.
Why would I stay?
Yeah. So I don't care if you're a Magnificent Seven stock or not. Like, you're not doing anything.
Yep.
So there's some understanding there. Let's also talk about lessons that we can learn from history of looking at the S&P as it relates to the dividend. So the first thing I want to talk about is the total return. So if you look at the stocks, the dividends in the S&P, you have two types of companies in the S&P. You have the majority that pay a dividend. So you have their return plus a yield of cash, of dividend.
That's right.
And then you have the companies that don't pay a dividend, like the Amazons of the world, where they just have growth. There's the company is like, we're not going to give you any of our profit. We're going to use that to grow our company. And you're like, okay, just keep earning me 40% a year.
Yes. Keep growing.
And then you have those others that are like, okay, I'm not sure. They may grow 40% a year, but they're also going to return some of their profit to their investors.
Yep.
So these are the two. You have to look at the total return. So if you're just a growth stock, it's pretty easy. What you make me lately, you know?
Right.
If you're a dividend plus growth, you have to look at both of those in the S&P. So that's an insight. I mean, we talk about this a lot, but that's a very important thing. Why don't you help me understand, like, what's market resilience here?
So that's that dividend paying stocks that they're outperforming the non-payers. So really, there might be some years where the only positive return that you get is from your dividend. The whole market might be down from a stock price standpoint. But if you have that yield coming, or your cash is coming from the dividend payers, it could actually help be a net positive for you.
Yeah. One of the things that I love about market resilience, if you look at the S&P, and this is where the equally weighted S&P look versus just the normal S&P that's market cap weighted, can be very insightful. So if you look at the years where the S&P, the non-weighted one, it just crushes it and it's up like 20, 30, 40%. You look at that versus the weighted, and the weighted might only be up like 13% in the year where the S&P is up 30. Okay. This is the same index. The only thing that's different is one, everybody's the same, and one, your market cap weighted. And there's a 20% gap. On the flip side, if you equally weight when the market turns and you see those upper echelon, that's what really pulls the whole market down.
Right.
It's that those huge $1 trillion companies and the ones that are really close, they pull the market up and they pull the market down. It's a funky market where everything goes up or everything goes down, like an 08.
Mm-hmm.
An 08, the big, the small, everybody in between crashed.
Yep.
And there's certain market years like 2019 where everything went up, big, small, everything alike.
Right.
Those are the exception, not necessarily the rule. But one thing I love about dividend resilience, when the market's getting crushed, the best stocks out there are the ones that pay dividend, because investors don't panic and sell.
Right.
So the thing I love about looking at and understanding dividends in the S&P, if you pull out just the stocks that pay dividends, historically, those perform way better in market downturns than the growth companies. And the flip side, you're like, well, yeah, but the growth companies do way better in the market when the markets take off.
Yep.
That is not actually always true.
Right.
If you look at 10 growth years, you might have 7 where it's like a wash,
Mm-hmm.
where it's like, who did better, the growth or the dividend? It's not always the same. It's not always the growth. You might have 3 years out of every 10 where growth outpaces dividends every single time.
Right.
But you're going to have the majority 7 where it's like, it's not growth. It could be dividend stocks, which is very interesting.
Yep.
So that's why we're such big fans, because they grow and the resilience, they're not immune to market loss. They lose. Like, we pick losers every year, not on purpose, but unfortunately we pick them.
Yep.
But they're as a whole, if you do really good job building a portfolio, they can build up a lot of resilience, resistance to massive loss in the market.
Oh, and that's, just echoing that. That's where you see a lot of asset managers, money managers come in, and when the market is starting to dip, they will run to those dividend payers.
That's why they're so resilient.
And they know that they're holistically, we've talked about this, how to evaluate a healthy company. They know that those are the healthy companies because they're paying a consistent dividend and they're there. So it's like, all right, the market may be going sideways. We don't know what's going to happen, but we know at least these companies are going to run well during this time. We'll stay over here, we'll hedge, and then we can make decisions moving forward.
I would say we look back. How does that help us look forward? Okay, so what we understand about what we've talked in the S&P about dividends, what can we glean from that, or what can we help investors understand real value moving forward?
I think you got to really look at, if we look at the same setup, great companies are great companies. And if they have great cash flow and have a history of paying a consistent dividend, you got to think that that's going to continue forward. And we want that as we're selecting, companies for our portfolios. So that would be one great thing, is making sure that, hey, if they've been doing it for 25 years, there's a really high likelihood that this is going to continue into the future as well. And as long as their books are still looking the same, that dividend's going to continue to be there as well.
So there's been so many times as a portfolio manager where I'm asked to predict the future or something, and give a call, do a State of the Union or whatever. I couldn't tell you what my track record is, but I bet
there's somebody out there.
Yeah, but I can tell you there's been a lot of times where I've just been flat out wrong. There's been a few times where I've been right, and there's been a lot of times where I've been wrong. And I can tell you in recent history, going back to, I don't know if it was 2020 or 2018. I don't remember what year it was, but I remember there was some legislation that went into play, and I can't remember if it was all the money that was given out through the pandemic or what, or if it was before that. Trump made, when he was president, I think he passed some laws, and I remember it opening up the market and what companies could do with cash, and gave them cash because of tax cuts and different things. And I remember making a call. Everybody's like, how do you think this is going to affect the market? And I remember saying, this is going to be really, really good. Companies are going to pay excess dividends, or, they're going to solidify.
I forget what they called it, but it was that repatriation advertising, the money. He allowed it all to come
back into the United States.
the U.S.
So it wasn't
at a
the
lower
pandemic.
tax bracket.
Yeah. So I was like, oh, this is going to be great.
Yeah. They're going to buy back stuff.
No. What I said is they're going to pay dividends.
Okay.
I remember making the call, and I think I can put it on a video. We can probably go find it. And I was all excited about it. And boy, I couldn't have been more wrong. I mean, I was way off. What they did was so much smarter. That's where they did all the buybacks.
That's right.
And you look back in history, and when these companies come flush with cash, a lot of times they do what are really prudent things, where there's some naysayers out there where they're going to be like, buybacks are terrible. It's only making the wealthier and so on and so forth. But from a company standpoint, every stock that you have out there, it's a liability to pay a dividend. So if you're a dividend paying stock and you've got 1 million shares, you have to pay 1 million times whatever your dividend rate is. Well, if you can say, I'm going to buy back some of those shares, and you go from 1 million to 800,000, now you got rid of 20% of your liability. So buybacks are great because it can strengthen the stock. It frees up cash flow. It does so many different things. So when governments pass laws, whatever side of the aisle you're on, there are times when, like, as an investor, like, this solidifies this investment. I'm a big fan at times, with the right reason, of a buyback.
Yep. And
you look back over the history of the S&P and companies that have dividends, they buy back their shares way more than companies that don't. Because the growth companies are just about expanse. And a lot of times they'll raise money by giving more, the coming out with more shares. Where the dividends are like, we want to condense.
Yep.
And they're like, hey, we want to shrink because we want to lessen our liability to all these dividends. So if you're a shareholder, a lot of times that actually compounds. It gives you more solid dividend, less liability to the company, more cash flow to the company,
right?
Which is a very good thing.
It should be encouraging in these scenarios.
And the other thing I'd say as we shut this podcast down is just the case for dividend growth. We're big fans of that. We've talked many shows about that. So you have the growth of the stock, and then you have the growth of the dividend. What we're talking about here is the growth of the dividend. And if you look back in the history of the S&P, you're going to find tons of companies that have strong stock growth track records, and they have even stronger dividend growth track records,
right? Where
they've been not only paying their dividend yield year over year, like boring. Like there's nothing more exciting in investing than boring return, right?
Right.
Where they have just this boring track record of great return, and then they have this boring track record of not only paying their yield, but increasing it every single year for 20, 30, 40, 50 years in a row.
And that should be exciting for the investor who's got 30 years till retirement, or the investor who's in retirement right now and is using that dividend to live on. Because when you have a company that has a history of exactly what you said, paying a dividend and increasing it year over year, that's the icing on the cake. It just really allows you to be confident.
So the last thing I'm going to say to shut this show down for me, you might say something different. If you're an investor out there and it's like, well, I'm just going to buy the S&P, because it's historically made, 10% a year, and I'm just going to bank on that 10%. Oh, that is a strategy. A better strategy would be buy the stocks inside of the S&P, because the S&P index, you're not compounding your dividend. There is no dividend. Like you can go buy an ETF potentially, or some kind of, S&P index. You can't buy the index. It'd have to be a fund of the index,
right,
where you have the shares that mirrors it, but you're always going to get something less because there's movement in it. If you just bought just the dividend stocks inside of the S&P every single year, your returns would be, we should do a show on that. Owning outright individual stocks versus owning an index or mutual fund or ETF, you will always, on the dividend side, outperform, because you have that internal compounding of yield that you can't get in an index, because if you buy an index, it's not really a share.
No.
Now they might have a share price, but if you buy 100, you're always going to have 100.
Right.
If you buy the shares, and let's just say it's equal to the same 100, you could end up with thousands of shares over here because of those dividends. You can't compute that because there's no yield on this side, even though there is. It doesn't work the same way on the fund side than the dividend side. So my takeaway here for you is go buy the stocks. If you don't have a portfolio manager and this is something that you want to do and get involved, you can be simple and go buy an index. but more powerful approach, go buy the stocks that pay a yield inside of the S&P every single year.
That way you get the benefit of it.
Yeah.
And I think we just got our next podcast.
We're going to do
how an ETF yield really works.
Yes. As it relates to the S&P.
Dividend, yeah.
So, all right. So hope you enjoyed the show today.